The whole world has been showing its open wounds caused by the effects of the global economic downfall. Yet somehow, China has managed to keep its discretion regarding its inside issues even during the peak of the sanitary outbreak, which started on its grounds. However, there are only so many things that can be kept from emerging to the surface. Facing a major meltdown, China Megabanks are crashing at a pace that can't go unnoticed. In today's video, we're going to examine what's been happening with China's banking system and why are so many high-profile Chinese banks collapsing one after the other, complexifying even more the level of the damages the world will have to face in this new worldwide Great Depression. It is crucial to start by analyzing the events that led the circumstances up until where we are now. Since 2019, the Chinese economy has been demonstrating to the world that it hasn't grown as much as it previously thought it would. The data released last year not only discouraged the country's shareholders, who were frustrated with the fragile conditions of the economy, but disclosed that at that point, China's economic growth was considered to be the weakest in the past 30 years. Busy dealing with the trade war with the United States, a scenario that causes fear in the global financial market, takes a lot of time and negotiation skills. China still had an even more worrying matter on the line: the huge chaos that's been installed in the country's banking sector. Despite the temporary euphoria over the outcome of an agreement between countries, week after week, not much has been resolved. And it didn't take much time for this euphoria to turn into dysphoria, since in 2019 alone, 4 major banks were closed and many others presented signs of failure, meaning there were already much evidence of problems with the country's banking institutions. The collapse of Baoshang Bank, Bank of Jinzhou, Hengfeng, Henan Yichuan Rural Commercial Bank gave visibility to what was previously a concern kept behind the blinds. Although China is an isolated country and intends to remain so for a while, data on bank closures started to have repercussions in the media during 2019, when photos of bank employees holding a few bundles of money, affirming these would be the only reserve amount the bank would have, that is, there was no way to honor all withdrawals from all customers, went viral. Despite the initial cautious reaction of the population to avoid the government's repression and police enforcement, the Henan Yichuan Bank's clients ran to the branches as fast as they could to withdraw their money. After that, in an attempt to raise fewer suspicions about the cases, the country rushed to nationalize some of the operations. However, months later, Beijing let Baoshang Bank go under after being dramatically taken over by the central government last year, marking the first such insolvency since 2001, described by Reuters as a quiet warning shot fired at the Chinese financial markets. The liquidation of the bank, which was the municipal lender, is raising borrowing costs for small peers, and it's likely to push more of them over the edge. Definitely a risky move to try to cleanse the system while the economy is gradually crumbling. The Tomorrow Group, an insurer directed by Shujin Chen, who was unofficially extradited from Hong Kong to the mainland and hasn't been seen since, was its controlling investor, and he had to see his empire going into liquidation. By that time, Baoshang had 576 billion yuan, roughly $83 billion in assets, which were transferred to other banks, and whatever was left of the lender was then allowed to collapse. Meanwhile, China's asset managers were already having to manage loads of distressed credit, and regulators signaled the intent to improve the way risk was priced between banks. providing that everyone could assume loans to lenders were guaranteed, they would be comfortable to invest spare cash in feeble institutions, harvesting somewhat higher interest rates at no perceived risk. In that way, these borrowings assisted Baoshang to keep funding the Tomorrow Group's speculations. But, of course, this strategy backfired because since they implemented a deposit insurance scheme in 2015, officials have menaced to let poorly managed banks go bankrupt, and they have followed through. According to local media reports, the majority of the institutions that had lent to Baoshang took haircuts of around 10%. By contrast, the People's Bank of China guaranteed individual deposits together with wealth management investments, exposing its anguish regarding the possible accountability claimed from the people to the deposit insurance scheme. Furthermore, to prevent rates from soaring, the PBOC intervened in the interbank market as institutional investors were realizing that the market suddenly had a much higher degree of counterparty risk than what it was previously thought. On that note, as Reuters defined, Baoshang had set a template for failure because the central bank started to pause monetary easing, aiming to raise its short-term borrowing rates, and there were reports of mini runs on small lenders, some of which have non-performing loan ratios well into the double digits, which indicated that they intended to apply this measure to other banks as well. And, yep, they did. From that point on, the systemic infection stemming from the banks into the Chinese economy couldn't be overlooked anymore. Thereafter, China started to enforce limitations on money withdrawn in the Hebei province for both businesses and individuals that now couldn't move large amounts of cash without prior approval. The new restrictions outlined lenders to have to give one-day notice for withdrawals of more than 100,000 yuan. And businesses also would have to report transactions of over 500,000 yuan, while depositors were now required to share the source of their funds, and account holders started to be asked about their reasons for withdrawing money. This program is now being gradually expanded to the provinces of Zhejiang and Shenzhen. Correspondingly, another local report uncovered that 586 banks and financing firms were classified as highly risky by the authorities. And yesterday, Bloomberg released a piece on how the biggest Chinese banks had just posted their worst profit declines in over a decade. With a skyrocketing debt, the Chinese government started to request assistance from these banks to help them stop the downfall of the economy, adding pressure on next year's dividends payment plans. The Industrial and Commercial Bank of China, the world's largest lender by assets, China Construction Bank, the second largest, the Agricultural Bank of China, and the Bank of China all had a sharp drop in profits during the first semester of at least 10%, according to lenders, with loan loss provisions bouncing between 27% and 97% at the four banks. Since the Chinese $45 trillion banking system has been chosen as a first aid procedure to ease the worst financial pain in nearly 40 years, sparked by the generalized business shutdown due to the global health crisis, authorities have been requiring lenders to forego 1.5 trillion yuan in profit by increasing lending to small businesses deeply affected by the outbreak, deferring payments, and also providing cheap funding. As a result, the banks have been highlighting that the second semester will be at least as challenging as the first one. The ICBC has stated the global economy faces unfavorable conditions, including significant contractions in global trade and investments, volatile financial markets, limitations on interactions between countries, disruption of globalization, and heightened geopolitical tensions. Even though bad debt has surged, after being coerced by the government to lend to businesses, loans and advances at the four big banks rose between 7% and 10% in the first semester. On the other hand, over 1,000 commercial banks unveiled a 24% decrease in second quarter profits, with non-performing loans marking a record 2.7 trillion won. Last month, Citigroup Inc. chopped out 2020 to 2022 earnings forecasts for Chinese megabanks by more than 10 percentage points, declaring to expect them to suffer a further 13% decline in profit until the end of the year. Citigroup analysts, led by Judy Zhang, stated that under mounting political pressure, China banks not only have had to further cut loan yields to subsidize the real economy, but also need to accelerate counter-cyclical provisioning and adopt more conservative NPL assumptions in setting provisions. The potential negative earnings growth will overhang the China bank's near-term share performance. For these reasons, investors have never been so pessimistic about the Chinese lenders' perspectives. Shares at the biggest banks hit a record low valuation, trading at roughly 0.4 times their forecast book value, after performing poorly for almost 5 years now in both benchmark indexes in Hong Kong and on the mainland. Additionally, speculation on whether it will be possible for the Chinese government to continue the payment of about 30% of their profit in dividends has increased considerably. Last Friday, Bank of Communications, also a lender, announced a 15% reduction in profits and affirmed to be looking at its dividend policy ahead. Goldman Bocom Vice President maintained that the dividend policy needs to be aligned with the external environment and conditions. It's necessary for every bank to study their current policy. While trying to retain more capital, we should also handle the relationship between bank growth and shareholder dividends. Aligning with other global lenders to alert about the difficult economic outlook ahead, China is silently signaling that the worst is yet to come. For its part, HSBC Holdings Plc has warned that the repercussions of the sanitary outbreak is likely to induce loan losses of as much as $13 billion this year. And JPMorgan Chase Co. have been arguing that this will be an extended period of economic contraction, stressing that the government stimulus was making it more complicated to measure the size of the economic damage. Ultimately, the China Megabanks meltdown could result in a 20% to 25% profit reduction in 2020, according to Jefferies analyst Shujin Chen. She completed by cautioning that further reductions would hurt banks' capital even without any dividend payout and would be harmful to financial stability. China is now trying to gradually get back on track, with President Xi Jinping boosting his efforts to make the economy more independent in the face of the ongoing confrontation with the U.S. on many sectors, such as trade, finance, and technology. As tensions between the world's superpowers over Hong Kong caused mutual sanctions on politicians and officials of both sides over the past few weeks, China's biggest lenders are examining their accounts to avoid endangering their access to crucial dollar funding, especially because at the end of June, all big four banks had $1.2 trillion in such funding and could face fines for doing business with any of the 11 Hong Kong and mainland officials targeted by U.S. sanctions. In conclusion, having a banking system that's controlled by four big state-run banks, which are in control of the financial system, owning 50% of all loans, in that way, keeping the control of the system on the government's hands, is actually what may have disrupted the entire financial structure in the first place. This centralizing necessity to control all institutions may have been the cue to the rise for the huge shadow over the banking industry, filled with corruption and expensive loans. In March, the country's total domestic debt was 317% of the country's GDP, but some reports say that there are many loans off the books as well. To get to the point of allowing some players to publicly fail, China shows that their debt is too high to handle. As Wionews cleverly defined, China's banks are failing because the country has been fueling its growth with debt, and years of borrowing has made the banks hollow. China's banking system is a ticking time bomb, and if it were to explode, it will take the Chinese economy along with it.